Great. Perfect. Well, Mike, thanks for joining me today. We have actually an interesting topic, I think, this long-term care market. We're going to talk about kind of where it is, what's been happening. I think there's been a lot of changes in this space, and the real advantage here is I think it's evolved to a space where the products have become a lot more attractive. So. Anyway, my name's Jordan Pence. We're with Advisors Resource Company, and I've got Mike, our asset-based long-term care specialist, on today. Thanks for joining me, Mike. So I guess to start it off, everybody, a lot of people know me in our audience, but nobody knows you, obviously. So maybe, Mike, you can share a little bit about your background and your journey that led you to becoming, becoming a long-term care specialist.
Sure. Yeah, thanks a lot, Jordan. I appreciate the opportunity to be with you today. Yeah, it kind of reminds me a bit of the what is it, the Grateful Dead lyric, "What a long, strange trip it's been." Kind of a long route to get here, but yeah, I
Well,
mean, I was
that sounds like a lot of people's journey in the insurance business, that's for
yeah,
sure.
right. Yeah, so I was in the I guess that you could say the healthcare field. I worked for a company where I was selling durable medical equipment, covered a big territory, and was really successful in that role. But not long into that, I decided that I was looking for a change, and one thing led to another. And a friend of mine was working for Crump Insurance. I'm sure that
Okay.
name is familiar with a lot of folks here. Um, and a sales support position had opened up, and I came into the industry fairly green, didn't know much about it, but I worked my way up the ranks there pretty quickly in that role at Crump, and from sales support all the way into a wholesaling position. So a really strong background in both life insurance and long-term care. So that's where I, basically cut my teeth. And
Wow.
then, yeah. And so not, yeah, I'd say close to a decade into that, I was actually recruited by a financial planning firm. And
Okay.
so I went to work for a fintech company, a startup company, and that was a great experience, Jordan. I love that because I think it gave me a really unique viewpoint into how care planning really needs to be a central piece to a smart financial plan. Um, and then so was in that world for a few years, and then was recruited by Advantage Insurance Network, and that's where I landed here. That's where I'm at today, and so that gives you a little bit of a background into my history. But so again,
That's
strong. Yeah,
yeah, that's really interesting. What like attracted you to joining or getting into the insurance business so you were in sort of medical sales, I guess, and then you got
yeah,
into the insurance business, which is I mean, not that unusual because it's sales, right? I mean, it kind of
right.
comes down to that. Most of what we're doing is, selling. I mean, I think we're providing valuable advice as well, but it's mostly sales. So what attracted you to joining or getting into the life insurance business or life insurance adjacent, I guess you could say, with the
Sure.
LTC?
Yeah, great question. I think with most everybody in this field, it's for us, it's got to be more than just the compensation and the paycheck. I just think this is so important. I just love helping people.
Yeah.
That really drives me. That's what really makes me tick. And I think that parallels a lot of folks that are in this industry. And so um, so it was that, and then I also think to the long-term care side of things, it's the personal experience that I'm sure so many of us have had, whether it's parents, grandparents, family members, or what have you. I saw it firsthand with my mom,
Right.
and how important it was to have the long-term care solution. I mean, it was huge from the financial standpoint of it, Jordan, but I think what was even more impactful was how to navigate this time, these last few years of her life. That was, you know, that uncharted territory. So, you know, again, I saw it firsthand how impactful that was to have that kind of solution, and but then have someone help kind of navigate that territory for us too. That was equally as huge. So, yeah, I mean,
No,
it's
that
why I'm
makes a
here
lot of
today.
sense. Yeah, no, that makes a lot of sense. So I guess you're sort of, if you don't mind sharing, I suppose your mother ended up in a long-term care situation, and she, I guess, had some level of coverage available to help mitigate some of those expenses.
She sure did. Yeah.
That's fantastic.
And mom and dad were smart, right? They had that care planning conversation well before they hit those retirement years. And so I'm so glad they did. Jordan, I can't even imagine what my siblings and I would have done if she didn't have that resource to draw to. So it was huge for us.
Yeah, it certainly is. And I don't, I mean, you hear about it so much, and then it seems like, and maybe I'm jumping a little bit around, but it seems like somewhere around, like I got into the business around 2010, and like at that time we were selling, well, I actually didn't sell any, but all the other advisors that I knew were selling like these sort of traditional long-term care products, and it was all about, oh, can you get the guaranteed premium, the non-cancelability, and these types of things. And like fast forward to today, 15 years later, those you don't even nobody even talks about those anymore because I guess they don't exist.
Yeah.
But I guess it's changed dramatically since maybe the time that your parents purchased the policy. I don't know when they did the planning or bought a policy or whatever,
Yeah.
but I think it's changed dramatically over the past even 10 years.
It sure has. Yeah, I mean the type of policy that my folks had, it's there's no way you could find anything like that today. Um,
It
but
doesn't
I mean,
exist anymore.
yeah, but I mean, I think it's a great segue into, you know, what we were going to discuss today, and how we can, you know, talk a little bit about the landscape, how it's changed a
Yeah,
lot, and how it's great opportunities nonetheless.
right. So, what is the lay of the land currently? Like, what is the market, and what do you think is maybe driving, or what is the biggest driver for people to purchase these types of policies or implement these types of plans, I guess is a better way to put
Yeah,
it, because really it's a strategy when it comes down to it to take care of yourself and protect your wealth and whatever.
right, right. So, you know, a couple of parts to that question, you know, what does the market look like? Well, you know, you touched on traditional long-term care, and it still exists. It's a low barrier to entry as far as a cost perspective, and you know, any kind of coverage is better than none. So I'm glad that option is
Good
still
point.
out there and available. But I think it's not really a surprise that that type of option is kind of fallen out of favor. You touched on it a bit, where it may be a low entry point as far as cost goes, but there's a lot of drawbacks that come along with it. It's just not a question of if, it's a question of when those rates will increase. It's you know, that's a big detractor, and I think that's why it's kind of fallen out of favor. And
So these traditional policies, it almost sounds like they're more like an annually renewable term, where like you can
yeah,
buy it for almost nothing today, and then just over time that's going to tick up until it's like you put in all this money and you're hanging on to something that you can't afford at that point, right?
I love that analogy, kind of like that annual renewable term approach. That's very similar to that, and I think that's why, you know, we as insurance professionals, why we emphasize the, you know, how important permanent insurance is. And so I think that's kind of
Right,
the along those same lines is why, you know, an asset-based LTC solution is so powerful. But it's also referred to as hybrid
right.
LTC coverage, but it's all the same. But yeah, it's a big win, and it's really no surprise why that asset-based LTC solution has really taken a stronghold on the market today.
Do you know what the current like mix is of LTC products that's sold? Like if you compared the traditional to the hybrid style or the asset based style, do you know what the market share is?
You know, I wouldn't want to don't quote me on it, but I wouldn't be surprised if it's a 70-30 split, if not higher, leaning
Yeah,
more towards the asset-based LTC side. And I think for good reason, Jordan.
right.
It's hard to beat. It's hard to beat from a care planning perspective.
Well, and the way that we just described it, like if you're planning for something that's probably going to happen when you're older, and I guess you could say the same thing about annually renewable term, but annually renewable term, you wouldn't buy that for a permanent need, whereas long-term care is certainly going to be a permanent need. So it's almost, I just kind of thought of this term versus permanent type of discussion with regard to the
Yeah,
asset base versus traditional long-term care. And that seems like it's an appropriate analogy based on what you're saying.
I agree. Yeah, I agree wholeheartedly. I think it's a really solid way to describe it, and I think it's why it's so important for, again, us as insurance professionals to have that conversation with the clients, because it's just so vitally important. And as much as I hate to say it, I think it's a scenario where it's not a question of if, it's a question of when. So why not be as best prepared for it as we can, well ahead of the game?
So the landscape right now is, let's just say this hypothetical, 30% is traditional. We've talked a little bit about traditional, and the other 70% is mostly the asset-based long-term care. So what's maybe led to this shift, or maybe the old style traditional products going out of favor? Because again, 10, 15 years ago, everybody was selling the traditional products with a guaranteed premium. So I guess what over the past maybe 5 or 10 years has changed, or what have they developed to make these, you know, new quote unquote, like the new asset-based products more attractive?
Yeah, yeah, it's a great question. And if I step back and I look at it, I think a lot of it is just driven by well, a few different factors, right? It's the demographics, it's that aging population, just that at age 65 and older, I think in 2040, we're going to have over 23% of our population be that age or older. So I think there's just better
Wow.
awareness. Yeah. I think some other big factors that come into play are the cognitive issues that just seem to be more and more prevalent now, right? It's Alzheimer's and dementia that become more and more prevalent. You think of someone that goes on claim for that sort of need. I mean, my goodness, that can last for maybe up to a decade or even longer. Whereas most
Definitely.
traditional, most long-term care claims are right around 3.5, 4 years. But if there's any kind of concern with some kind of extended care planning event that would come along the lines with like an Alzheimer's, there's products out there that offer lifetime benefits. So I think that's definitely driving sales. Um, what also goes along with that is the younger population too, right? They're standing up and they're taking notice. They see that with their grandparents, their parents, or families, or friends, or what have you. They're understanding how important it is to have some kind of solution in place. And with the kind of that term versus perm analogy, why not lock in something that's going to be more permanent, that has guarantees, reliability, and predictability over the long haul? So I think that a lot of that is a big contributing factors into why asset-based LTC has taken such a stronghold.
Yeah, definitely. I think so as well. And why do you think the companies did away with some of the, and maybe I'm getting it wrong. They always called it like non-cancelable, non or guaranteed premium, on the traditional policies. Why is that not? I'm assuming that's just not available anymore. Like you can't buy
Yeah,
that.
yeah. I mean, it's really not available. I mean, again, you do have the likes of like a Mutual of Omaha. I think Thriven is still in that space with traditional or quote unquote standalone LTC. But yeah, I mean, it's that renewable premium that's going to, you just know it's going to increase over time. I think that, when you look at the history from when traditional long-term care came into fore leading up to now, I mean, it was filling a need, but I think to be honest, a lot of the insurers just didn't really anticipate persistency issues. They didn't expect, they're expecting maybe more policies to lapse. I think in a lot of ways, they just didn't really know how to wrap their heads around things from an actuarial standpoint to where a lot of times they've just exited that space entirely. And why that shift has taken place to more of the asset-based LTC solution. And I think it's all for good reason. And I think it all makes a lot of sense.
Yeah, you're probably right. And it sounds like if you go back, they probably just mispriced it.
Yeah.
And that's probably, I mean, I'm assuming that's what basically happened is some of those old policies were just mispriced. And I think what's interesting about this is we get a lot of calls from um, like fee only advisors and people like that, their client gets a bill from like Genworth or whatever, and it's gone up. The premiums are
Yeah.
going to go up to double, or they could cut their benefits in half. And it's always like, well, what should they do? And
Yeah.
it's like, I mean, you could keep that, but you're 75 years old now. I mean, a replacement will be like this. And it's kind of like
Yeah.
I don't know, it's kind of a weird discussion, it feels like for us.
It can be, and I think it's just the insurance conversation in general. The sooner we can start having this conversation, the younger the client is when we can have the conversation, and the sooner we can put that plan into place, the better it's going to be across the board. And so I think that just largely, if advisors are not really focused on this space, if they if they don't dedicate the time and the resources to having this conversation and to put this kind of coverage in motion for their clients, that the advisor's missing out on huge revenue, and the client could potentially be left in the lurch. So I think it's why I'm here today, and why the conversation's so important.
Totally. Yeah, no, I totally agree, Mike. I think that's a good point. You and I were actually in a study group meeting together, and I got an advisor, I think he was from Canada, brought up a lawsuit in Canada about like the advisor could offer some sort of like or advertise that they offered some sort of critical illness and didn't give that to some client, and they had some sort of long-term care issue. I don't know if you remember the specifics of that, but when I was sitting there, I was like, man, that's really interesting. And actually, a couple of the advisors that we work with, I've given them letters that they can deliver to their clients to say, basically, we've presented a long-term care solution and I've declined to buy it. And then they're putting that in the file. And I mean, as I think a good compliance protection measure. I don't know what your thoughts are on that, or if you've seen any other advisors do that.
I agree with you wholeheartedly. I think that's such a smart move. Um, and yeah, I do recall that scenario, and I just think it's so important. Um, yeah, I love the fact that we're tracking that. We're showing that we presented this idea, and for whatever reason, if there was that decline, or they're maybe going to punt down the road a bit, at least we've shown that we're demonstrating that value. And the other thing that I guess I could just add to that, Jordan, is I think this is going to be a situation where it creates stickier clients, and multi-generational clients as well, right? So if we can show to that younger generation that, hey, Mr./Mrs. Advisor, they really took care of mom and dad, that gives us even that much more confidence that they'll be able to take care of us down the road. And I think that's why, having this conversation can be just so impactful on so many different levels. So it's a
That's a really
important one
good
to say
point,
the
Mike.
least.
And actually, if they do go on claim, who do you think is going to be helping get the claim paperwork filled out? It's that next generation. It's the kids of your
Yeah.
clients that are going to be helping with that. And so, not that it's all about making the advisor money, but you need to develop a relationship with that second generation, or you know, those clients are going to leave you forever.
No
And
doubt.
obviously, the younger generation, there's insurance, investment, whatever else you do, opportunity involved with it, I think, at least.
Yeah.
So, back to like uh, the kind of product discussion, I suppose. So, the is there any other options that people consider besides the asset-based and the traditional? I know
Hmm.
there's potentially some riders and things like that, but maybe you can get into a little bit more detail on the various maybe product options, and then we
Yeah,
can discuss that further.
you bet. So, I think a lot of it is just going to boil down to, what's the main objective? So there's essentially three different product types, right? There's traditional long-term care, there's asset-based long-term care, and then there's life insurance with living benefit riders, like a true long-term care rider or chronic illness rider. And I think really what it boils down to is, where are we looking for the best leverage? Like I talked about before, if you want to lock in that long-term care coverage at the lowest possible price point, a traditional long-term care solution could be a good fit, but we also have to understand the drawbacks that come along with it. It's the use it or lose it nature of that, which I think has made it fall out of favor. It's pretty much the guarantee that pricing will increase over time. It's why we see such a powerful solution with asset-based long-term care. Jordan, I think it's because it's the guarantees, it's the reliability, it's the predictability, right? So remember, with an asset-based LTC solution, the premiums are guaranteed.
Guaranteed, there can't change.
That's right. It's a
Okay.
contractual obligation from the insurer. So that's a really powerful story right then and there.
Compared to the
Think
traditional, yeah, that's extremely powerful.
you got it. You got it, right? And the majority of these asset-based LTC products, they're built on a life insurance chassis, whether it's UL or whole life. So you've got the guaranteed premiums, right? But there's also a death benefit that comes into play. So it can be that part of the conversation where, if someone asks, well, what if I end up not needing the care? Well, you've got that residual benefit in a death benefit that can be passed on to the beneficiary. So there's that guaranteed death benefit. There's also liquidity in it too, right? So these policies will build cash value along the way. Some are a little bit more tailored to bigger and better growth than others, where it's going to be a little bit more like a guaranteed UL, but there is some cost recovery that comes into play. So, that could be a
So
way
you
to
can like
counter.
kind of dial in like maybe a return of premium, or maybe some, depending on the product that you choose, maybe some potential cash value growth, or maybe a little bit better death benefit or a little bit lower death benefit. Just you can kind of dial it in based on what your concern is.
You got it. Yeah, absolutely.
So
There's
why
return
do you
premium
think that,
options too.
yeah, it sounds like it. Why do you think they made it a hybrid with a life insurance product? Is there any like regulatory reason, or is it just because of the death benefit component? Like, what do you think is the reason? And I guess I sprung that one on you. I didn't really think about that, but as you're talking, it's like, well, why combine it with the life insurance? You could
Yeah.
combine it with, I guess, anything in theory.
Yeah. I think it's more so, consumers are just looking for better optionality, right? And so they don't like that use it or lose it side of traditional long-term care. They want to be able to have some kind of recovery, right? If it's not the living benefit of the long-term care side of things, they have the ability to, if they did decide to surrender the policy, there's cost recovery with the cash value. And then
Right,
there's the death benefit too, right? I just think
right,
it was driven by feedback that the clients are looking for. They're looking for more bang for their premium buck, I guess you could say. And I think that's why asset-based LTC is such a great fit.
right. It's almost a natural fit. That way you can recover the premiums at some point, or recover what you put in. I think that makes a lot
Yeah,
of sense.
yeah.
So asset base implies that you're like maybe putting like a lump sum into it, but that's not always the case. Like, what's a typical? I mean, I know the traditional, you're going to pay for that for life, right?
Right.
And I guess if you did a rider on a traditional life insurance policy, like a full-blown LTC rider or maybe one of these critical illnesses, that's just funded like normal life insurance, like everybody's used to. You could do a 5 pay, 10 pay, lifetime pay, whatever. But is asset base always like just a deposit, or are there different ways to fund it?
That's such a great question. And the thing I love about that, Jordan, is it's now better than it ever has been. Now, the reason I say that is in the past with asset-based LTC, you basically had two payment options. It was a single pay or maybe a 10 pay. But now there's more options, right? There's limited pay designs where you could pay a 5 pay, a 10 pay, a 20 pay to age 65. And what's even
That's
better now is
nice.
yeah, right. And then now we have lifetime pay options too.
Wow.
So I know it's great, right? And the thing that I love about that is I talked about how one of the biggest barriers to entry, a lot of reasons why folks maybe don't, consider this kind of coverage is cost, right? That's obviously going to be a big one. But with that lifetime pay option, we're we're bridging that affordability gap. So that more frequent pay design makes it more affordable. And here's what's even better, Jordan. I love the fact that the two carriers that offer that lifetime pay design, both Nationwide and One America, they offer joint coverage too. So
Wow.
you can build that on a joint UL survivorship UL policy, that same type of structure. So it makes the premium even more affordable.
Wow.
It's just such a great opportunity for both advisors and clients alike.
Yeah, it seemed like yeah, when they first came out, when this style of product came out, it was always, yeah, like you got to put 100,000 into it one time. So that's a really good product development because it kind of opens up the world to like 55-year-olds or 50-year-olds that want to take care of us. You know what I mean? Like that's where it seems like it
Absolutely.
opens it up because like your 65 plus year olds, they've got their nest egg stored up, and it's like, okay, fine, I've got a $2 million net worth. I'll put 100,000 into this. It's not going to affect my retirement income that much, but at least I'm going to take care of this specific problem.
Yeah.
So that seems like it would open up the door for somewhat younger ages, right?
Yeah. I mean, you took the words right out of my mouth. I think that's the best way to describe it. Now we've got that option for, maybe some of those higher earners at their younger ages, 35, 40, 45-year olds, where couple of different product options that are out there on the market today. One with Lincoln, their Money Guard Market Advantage, and John Hancock and their Life Care product. Those are built on variable and indexed UL chassis. So the thing I love about that, Jordan, is if you've got those clients, maybe those younger clients, those high earners, if they like the idea of time in the market, not
Yes.
only, I mean, they can have a more well-rounded benefit, right? So
Right.
there's time in the market where the benefit can maybe outpace what you'd see with an inflation rider, like a fixed inflation rider. But not
Right.
only that, not only can you have a bigger long-term care pool potentially, but what we see with those products is a bigger death benefit too. So I guess the message here is that we have so many more arrows in our quiver, so to speak, and it's just such a fantastic opportunity to capitalize on.
Yeah. And really, you need to work with an agency like ours that has an expert like Mike so that we can find the right option for your client,
Now
right?
you're talking. Absolutely. Now you're talking.
Well, it's funny you bring up that John Hancock product because I actually had our John Hancock external on maybe like 3 or 4 weeks ago, and we talked about a little bit about that new John Hancock product, which I thought was extremely interesting, especially the index on that because of the potential upside. Like to me, I'm relatively young. I'm 37, and like to have a guarantee product. I mean, 10, I wouldn't probably buy one today. I'm a little too young, maybe not. I don't know, Mike. Maybe we need to talk about that. But I mean, to have just a straight guaranteed product is not that exciting for somebody that's somewhat younger, Like I could see if you're 65, guarantees all the way, right? You don't have time
Yeah,
to wait for the market to go up or whatever. But for someone maybe a little bit younger, that would make that type of strategy even more attractive, I would think.
100%. Yeah, and that's what I love about the shape of this market today is, I mean, I think put it in real simple terms. If you've got the client, no matter what their age is, no matter what their funding source is, we're going to be able to find a solution that's going to be a really compelling story, give them that peace of mind that they're looking for. I mean, it's just such a fantastic value prop that we can put right there in front of them. Powerful story.
Yeah, so when you think about it, like obviously the younger ages are pretty attractive to the uh pay for 10 years, pay to 65, whatever, 20 years. But are there any other sort of profiles that are attractive to different payment structures? I mean, we sort of addressed the people that are about to retire wanting to
Right.
do a lump sum, but is there anything else that maybe we missed or didn't think about?
Well, I think one that's really where we're seeing a lot of success recently is in the annuity space, Jordan. So, um, kind of think of it as a little bit of maybe a low hanging fruit sales opportunity, if you will, where, I think so many times we've got clients that, maybe they've got some money that's been earmarked down the road for some, maybe like a retirement annuity that, for lack
Right.
of a better term, is maybe collecting a little bit of dust, that we can just make that a lot more purposeful, where, we can take just a simple, 1035 exchange from that annuity into another um, Pension Protection Act compliant product, like what's available with Global Atlantic's For Care and One America's annuity care product, where it's an asset repositioning story, but it's a really powerful one, right? Where, with it being a Pension Protection Act compliant strategy, if you've got that, say, for example, that non-qualified annuity that's got a $50,000 gain in it, if that's put into either the One America product or that Global Atlantic product, when that money is being used for long-term care expenses, it's coming out tax-free. So what a great way
Really?
to, yeah, yep. So that's the beauty of the Pension Protection Act, right? Whereas before,
Wow.
it's that LIFO type structure that we're all familiar with, where, the gains are coming out first, and it can be a tax headache. But what a great
So
story to tell.
So if I have somebody who's got, let's say they've got a deferred annuity, they haven't annuitized, it's got some gain, yeah, it's got 100,000 gains, whatever, and I guess these two specific products, they might have some sort of underwriting requirement, but and you see that they might have a long-term care issue. Can you put it into one of these annuities and then pay it out over time?
You can, yeah. And so that's what I
Wow.
love about that opportunity, right? Is, so, because again, remember, I think a lot of times those monies are set aside without any kind of real purpose or direction. The idea
No.
is, well, we'll access that at a later time. And I bet
They
you,
never do anything with it,
I,
and they either die with a annuity with a gain, which is suboptimal, obviously, because of the tax treatment to the kids. You got all those deferrals, and then when you die, you pass on taxes, basically.
yeah.
And taxes at ordinary income, mind you. But
Mhm.
that is a really interesting strategy. So this is due to you called the Pension Protection Act?
The PPA, the Pension Protection Act, that was legislation that was passed back in, I believe it was 2006. It went into effect in 2010. But
Wow,
yeah, I mean, I think that's a solution that maybe a lot of advisors just aren't really aware of, where that money
definitely.
can, yeah, I mean, we can take that money, we can reposition it, we can put it into either a Global Atlantic's product or One America's product, and that can, depending on, and you brought up underwriting. The underwriting for an annuity based solution is going to be minimal. because we're just underwriting for the morbidity aspect. There's no death benefit component. So it makes the underwriting even that much more streamlined and efficient. That's a great way for maybe older clients or clients that
Yeah.
have some underwriting challenges, right? So that's a hugely powerful story that we can tell, where we can reposition that money. We can leverage it anywhere from 2 to 3 times based on the underwriting approval, where you've got a $100,000 non-qualified annuity that could be double or triple that contract value right off the bat, and leverage that money for long-term care expenses. It's a powerful solution, to say the least. So
Yeah, it's
we're
almost a
seeing a lot of
no-brainer.
success
Now,
with
the
that.
death benefit, if you die with that, they're still gonna, the beneficiary will still pay taxes on the growth when they die with
Yep.
it. If
Yep.
they don't use it for long-term care, let's say.
Correct.
But
Correct.
still, why, yeah, that's actually very interesting solution to that potential challenge for many people. Now, you couldn't go from annuity to like an asset-based one that's based on a life insurance policy. I guess I should say that obviously, right?
Right.
But you could go to one of these annuity solutions, which is actually quite interesting. So then let me ask you a different question. What if I had a mech, like a life insurance policy that was a mech,
Mhm.
and I wanted to roll it over into a life, one of these hybrid products? Would there be any negative tax consequences, or is that, I'm assuming that's fine.
I mean, once a mech, always a mech. But again, what are we looking to leverage the money for? If
Right.
it's going to be for long-term care, if that's going to be the solution, I don't know if the mech is really all that significant of a story.
Right. Yeah,
So
it's not that big of a deal because
right,
because the payments out of the long-term care will be tax-free anyways.
you
Right.
got it. Yeah.
Um, so when I was on the call, when I did the call with our John Hancock guy, he mentioned that their product is indemnity and then reimbursement. And we sort of touched on that, but the way that he described it, I thought was really interesting because it potentially avoids tax. So maybe you can explain that a little bit better because I think someone asked me about it, and I think I did a poor job explaining it. So maybe you can expand on why you would do
Sure.
that versus all indemnity style.
Yeah. No, I mean, I think it's a great question. Here's what I love about that product is you have the choice, you have the optionality where you can select either cash indemnity or reimbursement. Now, with indemnity, typically you're capped at a HIPAA per diem limit,
Okay.
but with reimbursement, you are not, right?
Okay.
So, um, but the thing that I love about that life care product in particular is you have that choice where you can select the cash indemnity option that will pay that benefit all the way up to the HIPAA per diem limit. And then
Which
once
is
you
like, what is that right now? It's like 10, 12,000, something like that.
12,600 a month, I believe, is what it is.
12,006.
Yeah.
Okay.
Yeah. And it's adjusted year over year by the
Index to
IRS. But
inflation, right?
yeah, yeah, you got it. But so yeah, I mean, you can go up to that HIPAA per diem limit, and then at that point, you then can switch over to a reimbursement model. You just have so much more flexibility now. And so maybe kind of changing the subject a bit, that's the case with most of the reimbursement carriers now. John Hancock, Lincoln, One America, they'll offer anywhere from about 75% all the way up to 100% of that benefit that can be accessed via cash indemnity. But Jordan, I love both because whether it's indemnity or reimbursement, the thing I love about that is it's going to make the client whole from a care planning perspective. So for me, I think that's less of a concern, but it's more about just locking in that coverage when you need it the most.
Yeah, I seem to remember like when the asset-based long-term care first came out, it seemed like a lot of them were just only reimbursement as the option. Now are all of them basically this sort of hybrid between the reimbursement and the indemnity style?
Not all of them.
Okay.
So where I think Securian and Nationwide have a really compelling story is they're 100% cash indemnity. And there's no special levers to pull or what have you. There's no special qualifications. Once once you go on claim, once you've met an elimination period, you're paid cash money. You can take that full amount, you can take a partial amount, whichever you prefer to do best. And I think the thing I love about that is it just offers so much flexibility. You can use
Yeah.
that money for, if you don't need all of it, but you take that full amount, you could use a portion of that for maybe some home improvement, put in ramps, grabber bars, you could hire a dog walker, you've got so much
Yeah.
flexibility and optionality with that. So just
Well, and
know
it
that,
always seemed like reimbursement would be such a burden on either the kids or the spouse that doesn't have an issue,
yeah,
or I mean, I'm sure the insurance companies like help out somewhat, but
they
and
do.
reimbursement seems like it'd be a mega pain.
Well, it's not as bad as it used to be, right?
Okay.
There's concierge style well, that was a mouthful. Concierge style type of approach that a lot of these reimbursement carriers offer, where they can offer direct billing. It's just one less burden on the caregiver that's responsible for it. But at the same time, though, even though we're product neutral, I love cash indemnity. It's such a powerful story, and it's one
I,
that I wish my mom had when she was on claim. It would have made my life a little bit easier. But yeah, Jordan, we've got to, regardless of the client or the care planning need, we can find a solution that's going to be a great fit.
no, I agree completely. Now, I kind of bounced around a little bit here, but you mentioned the taxes with regard to the PPA, the Pension Planning Act. Now, are there any potential tax benefits on premiums that you're putting into these types of policies?
Yeah, yeah, there sure are. And the beauty of this is the carriers that offer this coverage, what they've done is they have separately identifiable premiums, right? So
Okay.
the carriers break that out. So they'll identify what the premium is that's allocated towards the long-term care coverage that's considered medical coverage, and then that separate portion that's specifically for life insurance coverage.
Right, because you can't deduct the life insurance portion of it, of course.
Right. But you can with the long-term care component. So that's what makes this such
Interesting.
a compelling story for individuals and for business owners too. We're seeing a lot of success with business owners that use this as a way to attract and retain talent. Whether it's
Interesting.
mhm, yeah,
So will they do an asset-based policy?
yeah,
So you
yeah,
do an
they will.
asset-based policy, they'll pay the premiums from the business. Presumably, they're not doing a lump sum or anything. They're probably paying it over a number of years, maybe to age 65 or something like that.
Typically, yeah,
And
it's
then the
typically
portion that's life insurance, the employee or the person has to pick that up as income, and the remaining gets deducted.
yeah, that's correct. So
Wow.
it's a huge advantage for business owners. And so I think a lot of times advisors, if they've got a big contingent of business owners in their book, that's another option that we can explore. And it's a great way to not only lock in coverage, attract talent, retain talent, but they're going to be able to grow their business along the way too. So it's just a win-win across the board.
That's really interesting, and especially attractive for themselves, right?
For sure.
Um, I should actually probably talk to my mom and dad about that. I mean
Yeah.
that could be an attractive solution, especially if you own your own business. And because I assume if you don't have a business, the standard deduction might be greater than what you can get out
Yeah.
of the LTC, so that creates a bit of a challenge. But if you're a business, you pay for it out of the business, it doesn't matter what your standard deduction is, which
Right.
seems like it would be actually extremely attractive. Now, you don't have to have a special entity type or anything like that. Any entity can get the deduction, or do you have to be a special?
And I suppose that could open it up for a whole new discussion there. But it's treated a little bit differently, whether it's a C corp or an S corp or a partnership. But typically, when it's structured the right way, when the business is paying for the coverage, that long-term care portion has that tax favorable treatment. So it's a
Wow.
powerful solution.
Wow, that's pretty interesting. Well, I guess if it's maybe more advantageous if you're a C corp, probably I would imagine,
Right, right.
based on some of the stuff that I've read. But yeah, there's a great reason to do a C corp, and then you could also do a split dollar with them, which would be even better.
For sure,
Um,
for sure.
which would be arguably more interesting. Now, one challenge I think a lot of people face is this problem where if you're doing retirement planning, or if you have clients that are about to retire and maybe they're just W-2 employees, they have a ton of qualified assets. Now, is there
Yes.
any way to pay for this stuff and get a tax advantage by using qualified assets? Because I mean, I know they could take the money out of the qualified plan and then pay for it, but is there any other solution to that?
Sure is. And that's what I think that's just one of the main reasons why One America is such a huge player in this space, because they are that one carrier that will take qualified money. So that's a
Really?
really powerful solution, right? So just as an example, you could do an IRA rollover, and say you've got a $100,000 rollover into their asset care product. The really cool thing about One America is they'll apply a 25% bonus right from the start based on that initial value. Now, it's qualified money, right? So we're not going to be able to escape the grasp of Uncle Sam, if you will. But what's great about One America is they will take that 125,000 and then stage that premium over the course of 10 years to spread out and minimize that tax gain. But again, remember, what we're doing with that funding strategy is we're locking in the long-term care benefit that the client can expect and predictably rely on. There's a death benefit component. There's cash value growth within that solution. So it's a great way to counter those folks that say, well, all my money's tied up in a qualified account. Well, now we have that solution where you can take that qualified money, use that as a long-term care funding strategy. It's a powerful solution, to say the least.
So their solution is, I guess if I was gonna maybe look at it, it's sort of like using like a 10-year period certain SPIA to pay the premiums, but they're giving some additional bonus to it to make it even
Exactly.
better.
Yep, exactly. And it can
That's a
be
good
done for
idea.
both. Yeah, it is, right? And it can be done for both individual and joint coverage, which is a really powerful story to tell as
That's
well.
really interesting. So the other annuity-based products, like you mentioned One America and Global Atlantic have one, those cannot take qualified funds.
The only carrier that will take qualified money is One America.
With this
So
solution where they're pulling the money out of the IRA and putting it into the hybrid solution.
correct. Yeah, correct.
Interesting. That is really, really, really interesting.
Yeah, yeah.
So the only other thing, and I don't, that I wanted to just bring up is a lot of times you see chronic illness riders that come up. So what, I mean, that we've been focused mainly on asset base, and there is the LTC riders on life policies, but chronic illness is maybe somewhat different, I guess. Maybe
Yeah.
you can share a little bit about that. A lot of people are talking about ABRs. I mean, that's a pretty popular talking point, and I don't know how much of these ABRs actually even get used for this purpose. I think critical illness ABRs seem more attractive than chronic illness to me, but maybe you can speak a little bit about that.
Yeah, absolutely. And I mean, I think they're all great, right? But I think that there's some distinctions with those that are really important to highlight. I love that it seems like the majority of life cases that I see recently, and has been like this for a long time, is the majority of them will have some kind of ABR, right? Some kind of living benefit rider that's attached to it, whether it's a true long-term care rider or a chronic illness rider, a few different variations, right? Some have an explicit charge where it's built right into the premium structure. Thing I like about that is it's a little bit more predictable, right? So what that'll do is that'll draw down the death benefit dollar for dollar when they accelerate that for a long-term care need. So
That seems like
finally,
a more, yeah, not to interrupt, that seems like a more legit way to do it because it's, you know exactly how much you're going to get if you need it. You got a big death benefit, you got a decent LTC benefit. There is a material cost with that though, isn't there?
for sure, for sure. And it may be a little bit cost prohibitive, right? Those riders are not inexpensive, but there's
Hmm.
the other option that where you could look at something that's, I wouldn't go so far as to say that they're marketed as free riders, but I think they're sometimes kind of positioned as such, where it's like a mortality method or a discount method where it can make it a little bit more difficult to know exactly what the insured will be able to tap into once they go on claim. So once
Right.
they trigger that benefit, what kind of discount method's going to be applied to the death benefit can be hard to know exactly what they can draw from once that event takes place. And I think just stepping back from a bit, I think that's why it's such a big appeal with asset-based LTC, because you know what to expect. It's a guaranteed benefit. It's a guaranteed death benefit. It's a guaranteed accumulation that you just don't typically see with life insurance. So if the death benefit's going to be the priority, in all likelihood, the life insurance solution with an ABR or living benefits rider is going to be the best fit. But if we're looking at it from a care planning perspective, and we want, guarantees, we want that predictability, you're hard pressed to find a better value than asset-based LTC.
Yeah, it sounds like the ABRs especially are sort of like, here's some added value that we're throwing it onto this policy. Don't buy it for the LTC, but if something happens, you might be able to get something out of this. And it's like you buy I don't know, I can't think of a good analogy, but you buy a fast car and it happens to have a nice stereo as well. You didn't buy it for the stereo, but it's nice that it has the nice stereo.
That's right. That's right.
That's the best
Good
analogy I
stuff.
could think of. Sorry if that one's
I
weak.
like it. I like that one. It's a good one.
So, Mike, like all the advisors out there, what like tips would you give them? What should they be thinking about when talking to their clients? Is I mean, I think maybe I have this image in my mind for the wrong reasons, but I think certainly like and most people probably think the same way as like they should really think about this with their older clients. Like that kind of
Yeah.
what pops into my mind for whatever reason. Maybe that's because it's on their minds. They have aging parents. It's probably come up more with their friends and so forth. But what like tips or advice would you have for our listeners out there when it comes to this area?
Yeah. I just think it's so important to be having this conversation, and the sooner we're having it, the better. It's just like any kind of insurance coverage, right? Where the longer we put it off, the more challenging it becomes. Now, I think that's a fair point with maybe some of the younger clients. Maybe they're not thinking of that as forward looking as maybe they should. But I will say this, the thing that we can't ignore is there's more awareness now than there ever has been before. So I mentioned before where the younger generation is taking notice to this. And so
Sure.
I don't want to downplay that, right? Where advisors can start to have that conversation with even the younger clients, where, not to steal his thunder, but your contact from John Hancock, I'm kind of paraphrasing it, but he said something to the effect of, Mr./Mrs. Client, I noticed that you and your spouse don't have any kind of long-term care coverage. Was that something that was deliberate, or was it something that just never came up in the conversation before? I think that's a really powerful way to position it.
I think
Or
that is too, Mike. Like that, yeah, was that by undesign? Was that, oh my gosh, now I'm gonna screw it up. Was that by design or on accident? Whatever he said. I mean, I thought that was a fantastic line. You're right.
I
That's a
love it.
really, really powerful way to say it.
I love it. But it's just asking those questions, right? Have you thought about your care planning strategy? If you need care, how do you plan on paying for it? Um, have you thought about the impact that would have on your family, on your retirement strategy? If you do need care, where would you want to have that care? Who would you want to be providing that care to you? These are important questions to be asked. And I think that when advisors are asking these questions, it gets the gears turning. It makes that planning conversation that much easier to facilitate. And that's when you can, you can lean on Jordan and the team. You can use me as an extension to take advantage of that opportunity, and we'll make it happen for you.
No, I appreciate that, Mike. You're totally right. And it's just, it's like anything that you're doing, it's literally asking the questions. That's all it is.
Yeah.
It's just asking, hey, have you thought about this? Well, no, I haven't thought about this. Well, do you realize you can buy insurance that's guaranteed and you can get your money back if you don't use it to cover that? And it like, here's what it takes to implement that. It's not,
Yeah.
I mean, I guess for lack of a better word, it really is that simple. I mean, it's not that complicated,
Yeah.
So Maddie, do you want to throw up the contact information?
Yeah.
And I'll put this up on the slide. And Mike, I really appreciate your time here today. I appreciate all the insights. This is one of these areas that I like my eyes have been opened up over the past couple months because I've been looking at it, especially after talking with Joey from John Hancock and looking at that. And I think and the meeting we were at, I mean, just some of the comments that people made about how powerful this can be. I think it's exceedingly important, and all the advisors have to do is ask the questions, right?
I agree. And like I say before, if advisors are not, if they're not dedicating that time and the resources to this, if they're really serious about their growth strategy, this is such a huge opportunity. I kind of jokingly say it's the gift that keeps on giving. We view this as something that's going to outpace the opportunity that you see with life insurance and annuities. It's a solution that everyone needs to consider, and we're primed and ready to help you take advantage of this opportunity. So Jordan, I really appreciate it. Thank you so much.
No, Mike, no, this has been really informative. I hope everybody else enjoyed it. And you'll see my contact information if you have any questions. I will put that in the description of the video. But thanks everybody. Thanks, Mike. We'll see everybody soon.
Thanks, Jordan. Thanks, Maddie. Take care.
We'll see you.
Bye-bye.